3 weeks ago, we shifted our entire Wagner Daily model portfolio out of the stock market and into 100% cash. And since then, the Nasdaq has fallen 8.5% lower with us on the sidelines. In this video, we're going to talk about what the charts were telling us at that time that told us to get out and why. We closed our last stock position on March 5th. That's this day right here, when the Nasdaq closed the day around 22,750. Now, notice that we did not exit at the exact top. In fact, we exited about 5% below the all-time high. And that's because we were not trying to predict or call the top. That's impossible. Nobody does that consistently. In fact, we were simply reacting to specific signals that told us risk was rising significantly. The key here is we were reacting, not predicting. Now, we've seen this before because we've been publishing the Wagner Daily report continuously since 2002. We know what this pattern looks like. But before we get into the warning signs, let me show you something. Let's take a look first at what a healthy market looks like and what we actually want to see. So let's just scroll back here in the Nasdaq back to mid-2025. And you'll notice here that I've labeled for you the key moving averages that we follow. That's the 8 EMA, this green line, the 20 EMA, the blue line, the 50 SMA or 50 MA, the red line, and then the 200 MA, the yellow line. These are the MTG moving averages that we follow that help us determine our market timing model. Now, when we see this alignment where we have the 8 EMA above the 20 is above the 50, and the 50 is above the 200, that's what we call a bullish perfect stack. And when we see this alignment, it's full buy mode. It's time to step on the gas because all the signals are aligned. But if we fast forward to today, look at what we've got. The exact opposite. Everything's breaking down. Moving averages have flipped in the opposite direction. And this is pretty much the opposite of what we want to see. So how did we know it was time to get out? Well, here's exactly what we were watching. And it starts before the index ever confirms the breakdown. There are 5 key signals that can give you a reliable early warning that stocks may be headed lower. And this same methodology works for any type of asset, whether it's stocks, crypto, futures, or Forex. So let's walk through each of those 5 signals that comprised our early warning checklist. Number 1 is the performance of leading stocks. In a healthy market, stocks with top relative strength will actually lead the market higher, breaking out to new highs ahead of the benchmark indexes. However, when the market starts to get weak, one of the first signals you'll often find is stocks with top relative strength start to falter. For example, on this chart right here, this is a daily chart of Nvidia. Look what happened back on February 25th. We had some choppy price action going for several months. And on February 25th, the price action attempted to break out of that consolidation and continue its long-term uptrend higher. But instead, the price action breakout stalled. And we had a failed breakout the next day with this big, ugly red candle that sliced all the way down to the 50-day MA on massive volume. So what that tells us is that we not only had a failed breakout, but we heavily had institutions selling into strength of that failed breakout. So that's not the type of healthy action you want to see in a strong stock market. And LRCX is another example. All right, LRCX was a leading stock, leading semiconductor stock. And same thing happened. Look, we had a failed breakout here on the same day, February 25th, where LRCX tried to break out and tried to break out above its prior high after a bit of a correction and stalled. Now, we didn't have as much selling volume on that, but we did have a failure of the breakout. So often when you've got an early warning system in place, the first thing you'll see is leading stocks start to fall apart. Leading stocks tip you off first. And by the time the index confirms it, leading stocks have already made their move. Early warning signal number 2 is to look for 5 or more distribution days in the index within a rolling 5-week period. Now, what's a distribution day? That is simply when a major index like the S&P or the Nasdaq closes the day lower but on higher volume than the prior day. I've labeled each of the distribution days with a D and circled their price action. So there were 7 distribution days here within this 5-week period. And notice how each one of these days, the price action went lower, but on higher volume than the prior day. Now, that's a stealth warning that institutions are heading for the exit doors. Now, they don't announce their intentions, so it's very stealth. And that's why counting the distribution days is one of the most reliable signals that the market may be headed lower. Warning signal number 3 is when the benchmark index breaks below the 20-day EMA support. Now, by benchmark, we typically follow the Nasdaq Composite. Sometimes we'll follow the S&P 500 if we're trading a lot of non-tech stocks. If you trade crypto, then Bitcoin would be your benchmark index. So the benchmark is just representative of the entire asset class. So if we look back here at the Nasdaq, back into 2025, we had that perfect stack of moving averages where they were trending all in the right direction, pointing higher. But when we came into November, notice how that ended. The moving averages compressed and started to cross over each other, but the price of the index mainly stayed above the 20-day EMA, mostly. However, look what happened here. A distinct shift happened right in early February where the price broke down below that 20-day EMA, and this time it didn't get back above it within a day or two. This time it stayed below it. So the 20-day EMA was acting as support, but in early February it broke down, and that prior support now became new resistance, right? Prior support becomes resistance. We call that role reversal. And you can see what happened here on this day right here. In fact, it was a distribution day. The price tried to get back above that 20-day EMA and it couldn't. It stalled. There was selling pressure. So notice how prior to this point, the price action mostly was above this 20-day EMA. But since that point, look at how the 20-day EMA has been acting perfectly as resistance. Now, every attempt to rally above that 20-day EMA is met with selling pressure. So that's what we mean by the price action breaking below the 20-day EMA. And by the way, in terms of the distribution days, you want to look for clusters. Notice how we've got a cluster here of 3 distribution days within a 4-day period, followed by one a couple of days later. And over here, we had a cluster too. Now, warning signal number 4, the moving average is flattening. Well, in this case, we actually already had that a few months before because as I pointed out, our moving averages already started to flatten and cross over each other all the way back in November. So we had several months there where the price action was just, the moving averages were just crossing over each other, not only flattening, but crossing over. Now, sometimes this doesn't happen. Sometimes we go right from an uptrend into an immediate correction. So instead of having this crossover, you would simply have the moving averages compressing together, squeezing together like you see here, getting closer until they eventually cross. So when you see this, it means the healthy alignment that we talked about over here, this perfect stack, it's breaking down. And finally, warning signal number 5 is when the benchmark index definitively breaks below the 50-day MA. That's our red line. And of course, that happened as well. Right around the same time we broke below the 20-day EMA, we also convincingly broke below that 50-day MA, and the price hasn't even touched it since then. Once we broke below it, confirmed breakdown. So as you can see, pretty much the opposite of what we had in mid 2025, where we had all the moving averages stacked in the right direction. Now we've got the exact opposite shaping up. We have prices breaking down below support, and we have a bearish stack of moving averages with the 50 above the 20 and the 20 above the 8. On March 5th, the day we exited the last of our positions, all of these warning signals had built to the point where our rule-based trading strategy said, enough is enough, time to step aside. And that's exactly what we did. And again, I want to reiterate, when we moved to cash, the market was already 5% off the highs. Again, we're reacting to what we see. We're not trying to predict where the high is. That's a big difference. We didn't get out at the peak, but we did get out before the real selling began. And since we got out, the Nasdaq has been steadily lower and is about 8.5% below our exit point. It's a great feeling being on the sidelines, sitting out a decline in the market. But most traditional long-term investors simply don't have a plan for this environment. And I'm here to tell you that there is an alternative. And right now, we're living that alternative thanks to our swing trading methodology. In our community, when we're all 100% in cash, we call this SOH mode, sitting on hands. It means our capital is protected, we're not forcing trades, and we're waiting patiently for the next buy signal because no market goes down forever, just like no market goes straight up forever. SOH mode, sitting on hands, is not a failure. It's a discipline, and it means that our rule-based strategy is working exactly as it was designed. Now that signal, how to know when it's safe to get back into the market, that's exactly what I'm covering live. If you like what you saw here today, be sure to join me live on Thursday, April 9th at 7:30 p.m. Eastern Time, where we're going to be talking about the key technical signal that tells you when it's time to get back into the market without trying to pick a bottom. Links in the description. Be sure to sign up now to secure your spot. And also check out this video that talks about how to size your positions properly to respect risk. See you on Thursday.